Algorithmic trading and machine learning. Algorithmic trading, combined with the power of machine learning, is revolutionizing the financial landscape. This combination brings precision, speed, and efficiency to trading processes that were once unimaginable. For institutions and individual traders, understanding these innovations is essential for navigating today's financial sector. What is algorithmic trading? Algorithmic trading uses computer algorithms to execute orders based on market data and predefined rules. These algorithms identify trading opportunities and perform transactions at speeds far beyond human capabilities. The main advantage of algorithmic trading is its ability to process massive amounts of data and make decisions in fractions of a second, ensuring precision and optimal trade execution. At its core, algorithmic trading involves developing strategies based on historical data and market trends. These strategies can be simple, such as moving average crossovers, or complex, involving multiple indicators. Once developed, these strategies are translated into algorithms that automatically execute trades according to preset criteria. The role of machine learning in algorithmic trading. Machine learning enhances algorithmic trading by creating models that can learn and improve from market data. Unlike traditional algorithms, which follow fixed rules, machine learning algorithms can adapt based on new data, increasing their effectiveness over time. One of the most common techniques used in algorithmic trading is supervised learning, where models are trained on historical data to predict future market movements. Another technique is unsupervised learning, which identifies patterns or anomalies in market data without prior training. This is valuable in detecting new opportunities or risks that may not have been considered before. Reinforcement learning, where algorithms learn from the outcomes of their trades, is also gaining popularity. Benefits and challenges of AI in algorithmic trading. The integration of machine learning into algorithmic trading offers numerous advantages. It allows for more dynamic trading strategies that can adapt to ever-changing market conditions. Machine learning models can handle complex data sets and recognize patterns that may be missed by human traders or simpler algorithms. However, there are challenges. One major obstacle is data quality. Machine learning models require large volumes of high-quality data, and biased or incomplete data can lead to inaccurate predictions. Another challenge is the black box nature of some machine learning models, making it difficult to understand the reasoning behind certain decisions. High-frequency trading, HFT, strategies. High-frequency trading, HFT, is a dominant force in global markets, relying on powerful algorithms and ultra-fast data processing. HFT traders use these algorithms to exploit tiny price gaps that exist only for milliseconds. Market making and arbitrage are two key strategies employed in HFT. Market makers create liquidity by buying and selling securities throughout the day, profiting from the spread between the bid and ask prices. Using high-frequency algorithms, they can adjust prices instantly to market changes. Arbitrage is another common strategy, where HFT traders capitalize on price differences between similar financial instruments in different markets. Machine learning algorithms for trade execution. Machine learning has significantly transformed trade execution, automating the process and improving efficiency. Traditionally, trade execution involved human brokers who manually placed orders, often leading to delays and errors. Today, machine learning algorithms analyze vast amounts of data to determine the best times and prices for executing trades. One of the key benefits of machine learning in trade execution is its speed. Algorithms can react instantly to market movements, executing trades at optimal times. This speed is crucial in volatile markets where prices can change in milliseconds. Additionally, machine learning algorithms can minimize the costs associated with trading, such as slippage and bid-ask spreads. Reinforcement learning is particularly useful in optimizing trade execution. These algorithms learn from trial and error, continuously refining their strategies to improve future trades. Supervised learning techniques, such as neural networks, are also widely used to predict market conditions and inform trade decisions. Challenges and future directions. While machine learning has revolutionized trade execution, it is not without challenges. Data quality remains a critical issue, as models are only as good as the data they train on. There is also the problem of overfitting, where models become too tailored to historical data and perform poorly in live environments. Despite these challenges, the future of machine learning in trade execution is bright. advances in artificial intelligence promise to further enhance the ability of algorithms to predict market movements and execute trades more effectively. Introduction to backtesting. Backtesting is a critical method in trading and investment that helps bridge the gap between theoretical strategies and actual market performance. It involves applying a trading strategy to historical market data to evaluate its effectiveness. Through backtesting, traders can assess a strategy's performance before committing real capital. Understanding backtesting. At its core, backtesting assumes that if a strategy worked under specific past market conditions, it could potentially perform well in the future. This method relies on historical data, which includes price movements, trading volumes, and market indicators. Some advanced strategies even incorporate macroeconomic factors. To conduct a backtest, traders define a strategy that includes clear rules for trade entry, exit, portfolio allocation, and risk management. These rules are then programmed into a backtesting system that simulates trades based on historical data. The process of backtesting. The backtesting process begins with selecting relevant historical data. This data set must cover a variety of market conditions, including bull and bear markets, periods of high volatility, and economic downturns. A diverse data set helps ensure that the backtest results are comprehensive. Each trade is recorded and outcomes are tracked, including profits, losses, and costs like fees and slippage. Slippage refers to the difference between the expected price of a trade and the price at which it is executed. Analyzing backtesting results. Once a backtest is complete, traders analyze the results to assess the strategy's performance. Important metrics include net profit, total earnings from the strategy, total return, the overall gain or loss, maximum drawdown, the largest drop in portfolio value during the backtest. Sharpe ratio, this measures risk-adjusted returns. These metrics help traders understand the risk and reward profile of a strategy. Patterns may emerge, indicating strengths and weaknesses, such as performing well in bullish markets but failing in bearish conditions. Insights from the results help refine the strategy for different market scenarios. Limitations of backtesting. While backtesting is a powerful tool, it has notable limitations. One significant limitation is the assumption that historical patterns will repeat. Market conditions are influenced by numerous unpredictable variables, so past performance does not guarantee future success. Overfitting is another common issue, where a strategy is overly tailored to historical data, making it less adaptable to future markets. A strategy that seems flawless in a backtest may perform poorly in real-world trading. Using incomplete or incorrect data can skew results, leading to incorrect conclusions. The future of backtesting. Technological advancements are shaping the future of backtesting. Increased computing power and sophisticated algorithms have made the process more efficient. Machine learning is particularly promising for enhancing backtesting, allowing for more complex simulations and reducing overfitting. These improvements hold the potential to make backtesting even more predictive and reliable. Sentiment analysis in trading. Sentiment analysis is an emerging approach in trading that blends finance with data science to gauge market mood. By analyzing various data sources like news articles, social media, and financial reports, traders can assess market optimism or pessimism. Sentiment analysis involves processing vast amounts of text to detect emotions. This can range from counting positive or negative keywords to using natural language processing, NLP, and machine learning to grasp subtle language cues. The psychological aspect of markets makes sentiment analysis particularly valuable. Markets are not driven solely by fundamentals and technical factors. Investor sentiment plays a significant role. Positive sentiment can drive buying, while negative news may lead to selling pressure. Challenges in sentiment analysis. Despite its potential, sentiment analysis has limitations. Language is inherently complex and contextual, making it difficult to detect sentiment accurately. Sarcasm and irony, for example, can lead to incorrect sentiment assessments. Additionally, the fast-paced nature of markets means that sentiment can change quickly. By the time an analysis is completed, the market may have already reacted, rendering the insights outdated. This makes real-time data processing essential, though it can be resource-intensive.